Welcome to My Best Wealth. I'm Elena, and today I'll start with a confession. The concept we're about to explain. I myself misunderstood it when I first started in finance.
I'm Marco, and Elena's not the only one. This is probably the most common mistake we see across investors of all levels. But don't worry, today we're going to make it crystal clear. Let's get into it.
And today we have a topic that will surprise you, because what looks like a harmless formula hides traps that have cost billions.
Today we're talking about the Sharpe ratio, the metric that should have stopped Madoff before he stole $65 billion. How can a formula so brilliant also be such a dangerous mirage?
That's exactly what we're going to unravel today. Our colleagues will explain it in depth. Carlos, Laura, take it away.
Imagine it's the year 2000. A financial analyst, a guy named Harry Markopoulos, is looking at a report. And he zeroes in on just this one single number.
Right.
And instantly, literally instantly, he knows that Bernie Madoff is running the biggest financial fraud in human history.
It's wild.
Yeah, he didn't need to, order an audit or talk to disgruntled employees. He definitely wasn't digging through filing cabinets at midnight.
No midnight heists required.
Exactly. He just looked at this one mathematical anomaly in a totally standard, everyday financial tool. And for Markopoulos, that math was irrefutable proof.
It really remains one of the most remarkable stories in modern quantitative finance.
Oh, absolutely.
You have this outsider who takes a single glance at a metric that the entire global financial industry relies on literally every single day. And he just spots a fabrication so massive that it eventually vaporized billions of dollars.
Because he recognized the numbers were defying the laws of financial gravity.
Exactly. They were mathematically impossible.
And that is the focal point of our deep dive today.
Yeah.
We are unpacking that exact metric, the Sharpe ratio.
Yes.
We've got a massive stack of notes and research on quant finance here, and our mission today is to understand why this seemingly straightforward formula moves trillions of dollars around the world. And honestly, why relying on it blindly can create this extremely dangerous statistical mirage for you, the investor.
Yeah, to really grasp the power this formula holds over the market, you have to look at the psychology of risk.
Yeah.
The financial industry faces this enormous, almost gravitational temptation to reduce the chaotic, totally terrifying concept of risk down to just one single comforting number.
Like a safety blanket.
Exactly like a safety blanket, a
Yeah.
metric that lets you sleep peacefully at night. And the Sharpe ratio, well, it fulfills that psychological function beautifully. It offers the illusion of control.
But it is an illusion.
Completely. The danger only materializes when you start assuming this mathematical model is showing you the entire landscape. When in reality, it's ignoring massive hidden variables.
Okay, let's unpack this. Because before we can understand how this number acts as a global security blanket, we have to break down its moving parts. Like, what did William F. Sharpe actually create back in 1966?
So in the mid-60s, the market obviously knew how to measure raw profit, right?
Yeah.
The return.
Yeah, money made. Simple.
Right. But what institutional finance lacked was a standardized way to measure the efficiency of that return. Like, are you taking unhinged, wild risks to generate those profits, or are you executing a brilliant, calculated strategy?
Okay, so how does Sharpe solve that?
His solution was actually incredibly elegant. You take the portfolio's return and you subtract the risk-free rate.
And just to clarify for everyone, the risk-free rate is something like a super safe government treasury bond paying out, say, 4%.
Exactly. You could just park your cash there and do nothing. So that subtraction is the crucial first step. By discounting the risk-free rate right off the top, the formula forces the fund manager to justify their existence.
I love that. Like, why am I paying you if I can just get 4% from the government?
Exactly. If a manager takes on massive stock market risk just to earn a tiny fraction more than a guaranteed bond, they are actively destroying value relative to the risk they took.
Right.
So you take that resulting number, the excess return, and you divide it by the standard deviation of those returns.
Okay, standard deviation. That's the statistical measure of how wildly those returns disperse from their average over time. Right?
To volatility.
Got it. So to make sure you, the listener, can really visualize how this division penalizes erratic behavior, imagine two cars. Both are driving at exactly 120 kilometers per hour.
Okay.
Car A is cruising on a freshly paved, perfectly straight highway. Boring, but super safe.
Nice and smooth.
But car B is going that exact same speed, 120 kilometers an hour, but it is swerving violently on this winding mountain road. Tires are skidding, it's nearly falling off a cliff.
Terrifying.
Right. The speed of the car is completely identical, but the stomach-dropping panic, the volatility, is brutal in car B.
And the Sharpe ratio is explicitly designed to penalize car B's driver.
Because it divides the speed by the amount of swerving.
Exactly. So the mathematical score for car B plummets. The formula rewards smooth, consistent compounding, and it heavily, heavily punishes chaotic fluctuations.
I mean, that logic makes total sense on the surface. But there is a structural flaw here, right? In how standard deviation actually defines risk.
Oh, it's a catastrophic failure in certain environments.
Wow, catastrophic.
Because by relying on standard deviation, the formula inherently leans on what we call a Gaussian assumption.
The bell curve.
Right. It presumes that financial markets always behave like a normal symmetrical bell curve. It assumes the terrain you were driving on is continuous and stable.
Okay, so help me square this circle then. If the fundamental problem in the stock market isn't that the car swerves left and right, what is the actual blind spot here?
The blind spot is that sometimes the road entirely disappears from under your wheels.
Ooh.
Yeah, without any warning. The formula simply does not compute extreme, discontinuous events. It's great at measuring the bumps in the road, but it is completely blind to the cliff edge.
Which is frankly terrifying when you consider how many trillions of dollars are tied to this math.
Oh, absolutely.
So now that we understand how the formula attempts to calculate this balance of risk and return, we need to map out what these numbers actually look like in the real world, the plausibility spectrum.
Right, so we can see how Markopoulos caught Madoff.
Exactly. So let's establish the baseline using our research notes here.
Yeah.
The baseline for the S&P 500, the long-term historical average, sits at a Sharpe ratio of roughly 0.4 to 0.5.
Yeah, and context is important here. A score below 0 means you're literally losing money or you're underperforming that basic cash rate.
So 0.5 is decent.
A score of 0.5 to 1.0 is considered highly competent for a professional. But, and this is a crucial nuance, that S&P average is not some unchangeable law of gravity.
Right, because of the volatility.
Exactly. The volatility of the free market drags that number all over the place. Like in 2022, the S&P 500 registered a Sharpe of minus 1.2.
Ouch.
But then the very next year, in 2023, it rocketed up to a plus 1.77.
Okay, so that brutal dispersion, that messiness, is just the reality of a free market. And that brings us right back to the hook. Bernie Madoff.
Right. Madoff wasn't just generating high returns for his clients. That wasn't the real trick.
What was the trick?
The bait on his hook was the complete and total absence of dispersion. Madoff reported a Sharpe ratio hovering between 3.0 and 4.0.
And he did that for 15 consecutive years.
15 years.
Just to vividly paint this picture for you listening, if the S&P 500 averages a 0.5 and hitting a 1.0 makes you an elite legendary manager,
Right.
it's a sustained 4.0 over a decade and a half means the graph of your profits is literally a perfectly straight 45-degree line pointing up and to the right.
Untouched by reality.
Exactly. Completely unfazed by tech bubbles bursting or global recessions or geopolitical crises. Not a single meaningful dip.
And that's exactly what Markopoulos saw. He calculated the supposed volatility of Madoff's stated strategy and realized it was impossible.
Madoff claimed he was doing a split strike conversion, right?
Yes, that was his cover story.
So mechanically, with a split strike, you're buying a basket of stocks, selling call options to cap your upside, and using that cash to buy put options to protect your downside, like a collar.
Right, but the thing is, with that strategy, you're still inherently tied to the underlying market.
You can't escape it.
No, you can't. If the market plummets severely, or if you just suffer the persistent frictional costs of constantly buying that protection, your portfolio is going to experience volatility. It has to.
But Madoff's denominator in the Sharpe equation, his reported standard deviation, was basically 0.
0. The math dictated that market risk simply didn't exist in his universe. So Markopoulos didn't need a whistleblower. A Sharpe of 4.0 derived from a split strike conversion is a mathematical impossibility.
It was an unimpeachable fire alarm.
Exactly.
Okay, so if a 4.0 is criminal fraud and you're going to prison, what is the legitimate ceiling for a financial genius playing by the rules?
The benchmark for the absolute ceiling is widely considered to be the Medallion Fund, which is managed by Renaissance Technologies.
Oh, the legendary quant fund.
Right. They employ literally hundreds of PhDs, physicists, cryptographers, pure mathematicians. And they process petabytes of data to isolate and exploit microscopic market inefficiencies in milliseconds.
And what is their historical net Sharpe ratio with all that brain power?
Between 2.0 and 2.5.
Okay, so what does this all mean for us? Let's solidify this spectrum. A 0.5 is your standard, messy free market. A 2.5 is the absolute pinnacle of supercomputer-driven institutional advanced math.
And anything breaching a 3.0 is a screaming siren telling you to evacuate your capital immediately.
Exactly. So that spectrum is a great survival filter.
Yeah.
But the story gets infinitely more complex when we aren't talking about illegal Ponzi schemes.
Right, the legal stuff.
Yeah, completely legal funds that manipulate the mechanics of the math to engineer statistical mirages. This leads us to the 3 deadly traps of the Sharpe ratio. Let's look at trap number 1. Blindness to tail risk.
Or what quantitative analysts call kurtosis.
Kurtosis.
Yeah, kurtosis measures the fatness of the tails in a probability distribution. So basically, how often extreme catastrophic events cluster at the edges compared to a normal bell curve.
Okay.
Because the Sharpe ratio aggressively penalizes daily ups and downs, it inadvertently incentivizes strategies that completely eliminate daily volatility. But they do it by hiding that massive risk out in the extreme tails.
The industry shorthand for this is picking up pennies in front of a steamroller.
Yes, that's exactly what it is.
It's like, imagine selling fire insurance in a city that hasn't had a single fire in 5 years. You just keep collecting the premiums every day. Your return goes up, your daily volatility is absolute zero, and your Sharpe ratio skyrockets past 3.0.
Because the formula assumes fires follow a normal distribution, like one house burns this year, maybe one next year.
But it doesn't account for the whole city burning down in an afternoon.
No, it doesn't. And the SRF fund is the chilling real-world manifestation of this trap. From 2012 to 2017, this fund systematically bet against market volatility. They just sold volatility premium.
Collecting those pennies.
Exactly. And for 5 years, the market was calm. Their Sharpe ratios were pristine. They looked invincible.
But then February 2018 happened.
Armageddon. Volatility spiked with this unprecedented, violent speed. The whole city caught fire. The X4V fund lost 80 to 90% of its value in a single trading session.
Oh my God.
5 years of immaculate Sharpe ratios just vanished in an afternoon because standard deviation only measures the daily wiggles. It does not measure the probability of absolute ruin.
That is a staggering oversight. And it connects perfectly to trap number 2, which is maybe even more pervasive today because it leverages artificial liquidity.
Volatility laundering.
Volatility laundering, yes.
This distortion affects so many modern alternative assets. See, the Sharpe formula relies entirely on standard deviation derived from market pricing. If you hold shares in a publicly traded tech company, that price updates every millisecond.
Right. Every news cycle, every panic, the price jumps around. High standard deviation.
Exactly. But consider a private equity fund or a massive commercial real estate portfolio. Those assets do not trade on a live second-by-second exchange. The managers might revalue the portfolio internally, maybe once a quarter.
It's literally like saying you don't have a fever because you've decided to only take your temperature once every 3 months.
That is the perfect analogy. The underlying economic exposure is exactly the same. A privately held asset faces the exact same inflation pressures or labor shortages as a public stock. But the public stock's chart looks like an erratic heartbeat, while the private asset's chart looks like a flat line.
Because the data is artificially restricted, so the denominator of the Sharpe equation collapses.
Which artificially inflates the Sharpe ratio. It's an optical illusion. The risk isn't actually lower. The thermometer is just broken.
But even if you avoid private assets and stick to highly liquid public markets, you still hit trap number 3. Short period noise.
Statistics are utterly unforgiving when your sample size is too small.
Right, so our sources point out the period from March 2020, the bottom of the pandemic crash, through December 2021.
Yes.
Central banks everywhere just flooded the system with money, and the broader markets essentially went straight up.
If you evaluate a portfolio manager based on a 24-month snapshot of that specific environment, they might generate a Sharpe ratio of 1.0.
You'd think you found a genius.
But the models show that the standard error for a 24-month sample is incredibly high. It hovers around 0.7.
Wait, standard error 0.7, so if they report a 1.0?
Their true underlying skill level could realistically be anywhere from a mundane 0.3 to an elite 1.7.
Wow.
We literally cannot distinguish between mathematical genius and pure, unadulterated luck generated by a rising macroeconomic tide. To measure genuine talent, a manager has to weather a full crisis cycle.
Okay, so if this world-famous formula is blind to sudden collapses, easily manipulated by delayed pricing, and distorted by short-term noise, what tools do the financial elite actually use? How do they see the truth?
They view Sharpe as just a primitive starting point. They'll immediately stress test a portfolio using alternative metrics, like the Sortino ratio.
Sortino. This one is fascinating because it fixes such an obvious logical flaw. The top of the formula is the same return minus risk-free rate, but the denominator completely scraps standard deviation and replaces it with downside deviation.
Exactly, because think about it. If an asset you hold suddenly rockets upward by 15% instead of the expected 5%, standard deviation calls that high volatility.
Which means the Sharpe ratio mathematically punishes you for making money too fast.
Right.
That makes no sense. Upside volatility is the entire point of investing. Sortino fixes this because it isolates the data. It only calculates the variance of returns that fall below your minimum target.
It only penalizes you when the car swerves toward the cliff, not when it accelerates safely down the highway.
Exactly. What else do they use?
Another critical tool is the Calmar ratio.
Calmar. Honestly, that sounds like a metric designed specifically to measure direct pain to your bank account.
Well, you're not wrong. It measures the limits of investor capitulation. The Calmar divides your return by your maximum drawdown, usually over a rolling 3-year period.
So the worst crisis your money suffered.
Precisely. The fall from the highest peak of your wealth down to the absolute bottom of the pit. The S&P 500 has a Calmar of roughly 0.3 to 0.5 because it will periodically subject you to a 20 or 30% collapse.
So it basically tells you if a strategy is going to scare you into panic selling at the bottom.
Exactly. It's a behavioral survival metric. But when the data completely refuses to fit a normal bell curve, that's when analysts bring out the omega ratio.
Omega ratio. Sounds like pure science fiction.
It is powerful. It requires a total paradigm shift because it abandons standard deviation and symmetrical bell curves entirely.
How does it do that?
It takes every single potential outcome in a strategy's history and separates them into 2 buckets: targets met and targets unmet. It sums up the real probability-weighted ratio of the gains versus the losses.
So instead of pretending the market is a theoretical bell curve, it measures the actual area under the curve.
Right, and by doing that, Omega successfully captures those fat tails. It catches the black swans and catastrophic hidden events that Sharpe just ignores.
And briefly, just for that private capital issue we talked about, the thermometer problem, they use PME, public market equivalent, or TVPI. Those just focus strictly on the actual physical cash going in and out.
Right, they strip away all the delayed valuation theater.
Okay, here's where it gets really interesting. Because every single one of these alternative tools, Sortino, Calmar, Omega, they all point back to one central, highly uncomfortable philosophical truth about the markets we participate in.
The undeniable reality of the fat tails thesis.
Yes, traditional finance assumes the market is orderly. It assumes an extreme 5 standard deviation event happens like once every few thousand years.
But empirical history proves that is dangerously naive. Markets have fat tails. These extreme events happen constantly.
Black Monday in '87.
The 2008 subprime crisis.
Volmageddon. The 2020 pandemic crash.
The road drops out from under the tires all the time, which is why the distinction between ex post and ex ante is critical. Ex post is looking in the rearview mirror. It's that polished historical Sharpe ratio on a marketing brochure.
But as we saw with the XE fund, a great ex post Sharpe might just be hiding unexploded risk.
Exactly. Ex ante, the expected forward-looking reality, is the only thing that matters.
So to summarize this whole journey for you listening, the Sharpe ratio forced managers to justify their returns against government yields, which was brilliant, but it distorts reality. A 0.5 is the normal, chaotic market. A 2.0 is Renaissance-level excellence. And a 4.0 is Madoff's prison cell.
And relying on it without checking Sortino, Calmar, or Omega is essentially flying blind.
Yeah.
Which really forces a profound question. The global financial system manages trillions of dollars strictly optimizing for this one single metric.
And I want to take that exact premise one step further. This is the final provocative thought I want you to really mull over. We know human beings place blind faith in this metric.
Yeah.
But today, the vast majority of trading volume isn't human. The markets are ruled by automated AI and algorithmic trading bots that are mathematically programmed to ruthlessly optimize for the Sharpe ratio at the speed of light.
Oh, wow.
Yeah. If all the world's autonomous machines are hard-coded to optimize for a formula that is systematically blind to the road disappearing,
Yeah.
are we inadvertently coding the ultimate synchronized super crash?
That is a terrifying thought.
Could the very math designed to protect us from market risk be the exact trigger for the next Volmageddon? Keep your eyes on the road. And we'll see you next time on The Deep Dive.
Thanks, Carlos. Thanks, Laura. Great explanation as always.
Let us know in the comments if this has changed the way you see this concept. We love reading your thoughts. And if you want us to keep explaining concepts like this, subscribe and hit the bell. This is purely educational and informational content, not financial advice. See you in the next episode.
This is what we love about this series, taking concepts that seem simple and showing they have far more depth than we think. As always, we analyze, you decide. All the reports and charts we put into practice are available at mybestwealth.com.